Thank you, Roger. We have about 15 minutes on this panel, which I'll open the discussion to the floor. So just identify yourself, and I'll recognize you, and you can direct questions or comments or whatever. There's also a microphone, which might help. So. Let's see that we've stunned you into silence. Yes, sir.
I mean, everybody's polite.
I'll kick it off. I'm sure there'll be a lot of better questions. I'm Bill Primosh with the Montgomery College. I was also working on Asia at the State Department years ago. But one of the things that strikes me about these global imbalances is that we're kind of locked into the current trade rules with regard to exchange rates. They really don't deal with exchange rates. And the IMF, which I would have thought in theory would have had more of an oversight role, has had a passive approach to try to encourage market-based and flexible exchange rates, and particularly dealing with China. So is it really possible to get at the question of trade imbalances without looking at more fundamentally the trade rules and maybe even the role of the IMF?
I think the short answer is no. But there are many impediments to coordinated action, and you know those well. So I think the most likely outcome is that the U.S. will have to make some decisions for itself with respect to how it wants to manage its consumption savings ratios. And if it does that well, that is, put in place the right set of incentives, then I think what is going to happen is that it'll force others to respond. And you will get through a piecemeal process some kind of a return to a new equilibrium. Now, of course, if we could do this through the IMF, where you could have some sort of a model of re-equilibrating exchange rates, that would help. And I flagged this in the chapter by saying that would be the ideal. That is, if you could get coordination. But my skepticism about that is because people understand the implications of what that would mean for changes in their own national policy. And the temptation is going to be, no matter how attractive it is conceptually, to have a new Plaza Accord or to have a new arrangement. There will be resistance to going in that direction. And so I think the practical solution will be for us, because we are the largest consumers, to start putting in place national policies that basically damp down consumption in favor of increased savings. And then those who have consequences coming from those decisions will have to make their own adjustments. And so just in a political sense, I see that as the more practical way out, even though ideally we would be able to do this in some coordinated fashion. Now, there are many proposals on the table which look at re-empowering the IMF to take a more active role in doing this. And we'll see where that comes out.
Well, as a matter of fact, the IMF has had the responsibility for this field for decades. The problem is that they really have no leverage over the big countries. They have a lot of leverage over smaller countries, emerging market countries, and they're very useful. But to go toe to toe with the U.S. and China and Europe, that's tough, and that's got to happen. The U.S. knows what it has to do, but the question is getting the voters to agree. We're going to have some kind of consumption tax in order to deal with these big deficits, and it's very hard to sell consumption taxes at a national level in this country.
My name is Michael Gadbo. I'm with Georgetown Law School. My question comes at this interplay between trade and finance from a somewhat different perspective. If you look at the Bretton Woods system, created three institutions, the bank, the IMF, and the GATT. Of those three, the weakest was clearly the trading system. wasn't a full-blown institution, didn't have resources. Now, 60 years later, it appears to have gone from the weak pillar to the tent pole in the system, with a set of rules that is appears to be widely adhered to, and a incredible bulwark against protectionism, with the Chinese saying on the tire case, well, we'll take the U.S. to the WTO, and that seems to be helping to assuage their domestic constituencies. And behind that is really a set of rules, international rules, whereas finance seemed to have evolved quite differently. And I think, Roger, you typified the view of finance, which is we don't really want rules. It's too complicated. You wouldn't understand, and you would somehow hurt the innovative character of this industry. My question is you looked at this from the perspective of the Asian countries, and with the Chinese having come into the WTO and used it really as an instrument for transformation, and reflecting really a governance system which is much more secure, it seems, in terms of creating rules that people adhere to, whether there are any lessons from that for the financial system, and whether you really can solve the systemic nature of the financial crisis without a tighter set of global rules that goes beyond this notion of coordination or peer review, which is what people seem to have been able to rise to, but which doesn't really give you much sense that the system really will be able to withstand another crisis.
Well, let me just say that it started out with rules. The IMF Articles of Agreement said, thou shalt keep a fixed exchange rate. And what happened was it was unworkable because surplus countries didn't like to appreciate their currencies. And they like building up surpluses, and there's no way deficit countries can get rid of their deficits unless surpluses countries accept reduced surpluses. So that broke down, and that was the collapse of the Bretton Woods system and the movement toward floating exchange rates. That gave an exchange rate, shall we say, lever for adjustment. The problem is that the Chinese read the original text, and they said, oh, fixed exchange rates are good. It's still in the text, still in the Articles Agreement. They are following the rule. Very inconvenient for those who want to see balance of payments adjustment. So the last two administrations, Clinton and Bush, tried to get the Chinese to introduce, euphemistically, more flexibility. And we all know what that means, a stronger renminbi. And they went along part of the way, but grudgingly. And basically, they, in private, if you talk to Chinese officials, and we see them in New York all the time, whether they're in the banks or in the government, they say, yeah, we understand that this surplus we're running is unsustainable, just as unsustainable as your deficits. But we're patient, and you're an impatient country. So we're willing to make this adjustment over 5 or 10 years. I'm struck by Ashley's view of the short term and the medium term. You know, in the markets where I was been in for most of my career, even though I was started at the Fed working for Volcker a long time ago, before many people were born here. In the markets, the short term's a day, the medium term's a week, and the long term is a month. Well, for the Chinese, the short term is 5 years. Well, you heard it. So this is the problem. We have a semi-rules-based system. The Chinese are following the rule, gladly, and we're trying to get them to break the rule because the rest of us are stuck with the language, and yet we believe in a more flexible exchange rate system. But I'll guarantee you that even if we had the most flexibility of the renminbi, we still wouldn't solve what Ashley calls the macro problem of the saving and investment imbalance. And whenever I talk to people that advise the White House and they ask me, what would you do? I always say, impose consumption taxes. And then they say, how are you going to sell it? And I said, that's your job, not mine.
Can I have Peter actually take a crack at this? Would you mind answering this question as well? Let me get you a microphone.
I'd be happy to make some comments on the question of China's exchange rate. We may have an opportunity later on to discuss it. Let me just, my bottom line is that China's exchange rate did indeed become undervalued, probably still is undervalued. But what does that mean? Most people think if you then correct for that undervaluation, that things will be all right, that global balances will restore, and that's a big question. In my chapter in this book, I've looked at this question, struggled with these issues that are technically very difficult. Ultimately, I came to the conclusion that China's currency undervaluation was probably an unintended but almost unavoidable by-effect of its very aggressive, dramatic reforms, particularly in the manufacturing sector. China's trade is 90% manufacturing. Its surplus, its trade surplus, is a manufacturing trade surplus. China's productivity growth in the manufacturing sector, particularly after Zhurongji instigated the major reforms in the late 90s, that productivity growth was so high that if they had tried to compensate the nominal exchange rate for the relative productivity gains relative to, say, the US or other major trading partners, they would have had to appreciate so much that it might have killed significant parts of the rest of their economy, agriculture, service sectors. They politically didn't have the option to do what economists would have liked them to do. Undervaluation, trade surpluses were to some extent an unavoidable byproduct of China's very aggressive manufacturing sector reforms.
Hossein Ibn Yusuf, International Petroleum Enterprises. Energy is the world's largest business, and I was just wondering what kind of assumptions you had on energy, both price and alternative energy, in your projections. Thank you.
Unless I have completely forgotten the substance of the book, I don't think we engaged energy as a standalone issue, but it does appear in the context of the various country studies. So there is obviously, in a substantial way, it appears in the case of Russia, because there are natural resource issues that are linked to Russia's own equilibrium. But since the chapters focused on what adjustments have to take place within national economies, I think most of the authors treated energy as just one of the many components that go into the balancing decisions, rather than single out energy as something for treatment by itself. In previous Strategic Asia volumes, we have done things on energy standalone, but we didn't do it in this volume.
The climate issue in particular has a considerable impact, both on the economy and on energy use and the type of energy. That's why I raised that question, see if there was any link. Thank you.
Thank you. Surjit Man Singh, American University. I know that this discussion is on Asia and the United States, but seeing that the question of finance has come up as well as trade, what role do you give to Europe in all these global crises and management of crises?
Well, having worked for a European bank for 8 years, they feel victimized and ashamed of themselves. Victimized because they were basically led down the same path as many others who trusted. You could call my paper, the title of it, Misplaced Trust. And they basically trusted the rating agencies, the investment banks that sold them stuff, and their own staff, who basically took positions that, in retrospect, were totally riskier. And they're ashamed that they didn't exert more influence, and they felt that they had to react to what the U.S. was doing in terms of bailing out institutions. And as you know, the Germans, for example, have had to bail out Hupo Real Estate. The British bailed out Northern Re and Northern Rock, and many others as well. 3/4 of the British banking system now in public hands. So that they do feel victimized, and basically feel that they let their citizens down by inadequate supervision.
Name's Anupam Khanna. Now we come back to the systemic failure at the global level. As I think both of you have said, incidentally, a very good sort of meshing together. But that it's not a weak link, but a systemic failure whereby each element of the system sort of acts in a perverse manner to the other elements of the system. I think that's the way. Now, when you look at a crisis like this, then the question arises, then why did all the systems work in a perverse manner? It wasn't that people didn't warn against it. It wasn't that people weren't aware of it. Now, the experience of developing countries, most emerging markets, and other crises has shown that this has to do with essentially the distribution of political power or the invested interest, because they start acting in a particular way. And again, the experience of reforms elsewhere in the world shows that this is very difficult to change, and the only time it changes is either through revolution or through a crisis. But this crisis, we seem to have missed that opportunity. This is not my analysis, incidentally. It's sort of a simple version of Simon Johnson, who was the chief economist of the IMF. Now, if that is done, I mean, if that opportunity has been missed, and the power of the banking oligarchy, as he calls it, in the US is not going to change, I think you have a problem in the global sense, because people here are convinced that the US interest may not be any more GM's it. What is good for GM may not be good for US, but many people do believe, amongst the policy-making circle, that what's good for Wall Street is good for the US. But that's where all the dilemmas arise. So what is going to happen in the 5 to 15-year sense, as far as that is concerned, in terms of distribution of power? Because that will determine whether US will extricate itself or not. And from your side, how does that change the whole regulatory framework?
I don't think anybody in this administration is looking out 5 to 15 years. They're looking out month to month to see what kind of deals they can do with Congress to get something passed that will meet their stated objectives, which are very clearly stated in the Treasury white paper that came out this spring, and will handle as many of these lobbyists who are opposed to some of their key plans. So I think they're working in a very short time dimension, opportunistically, and I think that they're going to go back to fallback positions that will only scratch the surface of what's needed. So I am disillusioned and think that the change in regulation that will occur will be pretty marginal. Does that leave us exposed to another risk? Yes.
I was going to say something like that, but in a different way. That is, there is a lack of symmetry between the political calendars and the economic calendars. If you believe that somehow we will manage to get over the next, say, 3 to 5 years, which is my short term, but that these issues will come back seriously because we will not be able to escape the rebalancing questions over the next decade. The future of the dollar as the international reserve currency, et cetera, then you have to ask yourself, there are two ways to deal with this. One is we are going to let the markets do what the markets do, and we will take our chances. And the odds are that if you follow that process, we are going to have a meeting of this kind 10 years from now, once all over again. Or you can begin to say we make political decisions that take us in directions that will avoid that. And there are two sets of political decisions I think are fundamental, both very difficult to do. One is questions with respect to choices in the real economy. And that's what Roger is flagging with respect to consumption, how we change patterns of consumption, saving, all that sort of stuff. So these things have an impact in the real economy. These are things have to be done with it. Then second, I think there's the whole question of whether the institutions that at a global level have the task of oversight adequately represents the interests now of the new stakeholders in the system. This is also difficult to do because in part it involves our acknowledging that we may not be as important in the system today, in these institutions today, as we were 40 years ago. But what are the political incentives for the US government to, in a sense, act on these issues with any alacrity? I think the political drivers push you in the direction of simply making certain that there are no adverse effects that impact on you electorally within a much narrower time horizon, than trying to fix this over the longer term. I would hope that we get serious about this, but I have seen a whole range of questions, everything from the financial system to the so-called Afghanistan-Pakistan question, where irrespective of what issue you pick, the time horizons have been literally the next election, by which I mean the midterm election, which is a few months away. Yes.
Thank you. My question is related to the cause of the financial crisis. You referred in your opening statement to, I think, 7 culprits: the consumer, the borrower, the brokers, packagers, regulators, and the board of directors, et cetera, agencies. To take your own analogy of a murder mystery, Agatha Christie's, it seems while I was listening to you, these were well explained, that someone was missing in this list. And while you had mentioned that the board of directors, lots of board of directors did not really understand perhaps what they had, somebody did understand something. And it seems that a lot of the items on your list are perhaps only facilitators and tools rather than the main culprit, who actually committed the murder, so to speak, in the mystery. And, somebody did know how to package these packages and had an incentive. Who had the motive and the incentive to have these products from which lots of money were made on Wall Street. It seems to me that the incentive system has to be looked at, and I wonder if you can expand on that. Certainly, the incentive system presupposes the regulators as well as the other participants in the industry. But in this regard, that goes to the core of the issue of the free enterprise, capitalism, what actually Tellis is mentioning, the role of the United States, as you mentioned, in Europe, is blame because of that. So I wonder if you can expand on that aspect of it a bit.
Here's the problem, and it really is about psychology of ordinary people, not of criminals. When you make money and you explain how you made money to somebody else, they are impressed by your analysis. So whoever has made money lately seems smart, and people imitate their behavior. This creates, at the beginning, a trend, and then eventually a bubble. The problem is everybody is suckered in to success. We all worship success, and we all want to be successful. And so at the beginning of this process, we had the big facilitator was, in fact, the very low interest rates. I mean, the federal funds rate got down to 1%. Money, credit was widely available and very cheap. So that's the key facilitator. Now, what did people do with that credit? They mainly bought houses based, which were essentially not paid for out of their own money, but by borrowed money. And for about 2 years, everybody was right who did it. And if the world would have stopped there and everybody would have said, enough already, life would be better. It would have, in retrospect, if somebody in the regulatory area, maybe the chairman of the Fed, would have said, I'm getting a little worried about this bubble that's starting in the housing market and what it might mean. If somebody would have said that in a position of authority, not just a few observers like Jim Grant and my friend Nouriel Roubini and Bob Schiller at Yale and a few others, but people that had the command of the media, it might have made a big difference. It would have made an even bigger difference if the head of the chairman of the Fed would have said, There's many elements of abuse in these mortgages, and we're looking into it. People made this crisis, and people could have avoided that crisis by timely actions. But how do you go against somebody who's just made a lot of money? You get the chairman of Citigroup, he comes into your office and says, well, we've been doing this and this and this, and look at our earnings. What was Citibank doing as late as 2007, January? Buying back their own stock. They weren't building up capital reserves against a rainy day. They were essentially buying back their own stock because they were telling their shareholders, your shares are undervalued in the market. We're buying back the stock, lowering their reserves as late as January 2007. So human nature is a big problem here. And what you need, the reason why the regulatory system has a special role is that they take away the punch bowl, as McChesney Martin said, when the party is just getting going. The rest of us won't do that on our own. That's why we hire other people to do that for us. But this time, they didn't take away the punch bowl in time.
Well, on that note, what I will do is call the panelists of our second panel. We're going to do the China and India panel and move on to what might be the two bright spots in what is otherwise a dreary tale. But let me thank Roger for
We're a good team. Very nice.
Yeah, we should make money. Thank you.
It's easier to wrap it up in two.
Sure.
I'll try to watch.
That's great. Well, we should go straight away to the second panel because I want to keep this moving as quickly as I can. We're going to have Peter Botellier make a presentation on China, followed by Sanjay Abaru on India. And then we will proceed to a third panel that looks at Japan and Russia before we close. So without further ado, Peter, let me